In this video, we're going to look at Innovative Industrial Properties. This company is the leading provider of real estate capital for the medical cannabis industry. REITs lease and rent real estate that they own to businesses or individuals and use those payments to pay its investors in the form of dividends and also to run their business. So what I do in my videos is I run my discounted cash flow model to figure out the stock price of the company and also look at the financial ratios of the company and compare them to its competitors. And I do this with you, so it's like you're doing the whole process with me. So let's get started with the model. This company has a market cap of $2 billion. So it's a decent sized company, and their stock price is $91.67. So if you wanted to buy a share, it would cost you roughly $92. Now we need the free cash flow, and I feel free cash flow is the most important metric to look at because it's the cash that's left over after paying your expenses. So you might not think that's a big deal, but if there's no cash left over, what does the investor, you, receive? They don't receive anything. Also, companies need to grow their businesses. If there's no additional cash remaining, they don't have much funds to grow and become bigger. Let's look at their income statement to figure out their net income. That's their profit and loss. And we'll put that into the model. And now we're going to pull their revenue, which are the sales. And in this case, it's the rent and lease payments. So the numbers I input are here, the free cash flow, net income, and revenue. I also have the net profit margin. And it looks like they have nice margins in 2018 and 2019. So they're doing a good job of converting their revenue into profit. But you could see in 2016 and 2017, they had negative free cash flow and negative net income. That is not terrible. That may be an indication that they're investing a lot into their business and trying to grow it. In this case, they may be buying more real estate to lease out. But you always want to look at the income statement and balance sheet to understand it a little more to make sure that's the case. Let's look at the capital structure of the company to figure out the discount rate we need to apply to the future cash flows. This company has no debt, which is great. Let's figure out their cost of equity, so we need the beta for that. The beta is 1.33. That's how much the stock moves relative to the market. So if the market goes up 1%, this stock should go up about 1.3%. And if the stock market goes down 1%, this stock should go down 1.3%. Of course, it wouldn't follow this formula exactly, but over time, it should average out to that. Let's go back to the balance sheet. We need a little more information to look at the ratios later. Let's get their current assets. And current assets are mainly cash, accounts receivables, and inventory. And that's $117 million. They have $82 million in cash. Cash is the best asset. Let's get their current liabilities. That's $41 million. And this is the amount of money the company owes to other businesses over the next 12 months. We'll put that into the model. And now we need their equity, and that's total assets minus total liabilities. That's $548 million. Let's go back to the income statement and get their EBIT, earnings before interest and taxes. On the income statement, that's called operating income, and that's $25 million. Let's look at their capital structure. They're 0% debt, 100% equity, and the cost of equity is 12.5%, and we use the capital asset pricing model to figure that out. And 12.5% is the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all free cash flows past year 4. We discounted those numbers back to today, and we get a value of the company for $1.5 billion. We divide that by 22 million shares. We get an intrinsic stock price of $70. That's how much I calculate the stock is worth today. But they're actually trading at $92, so they're trading at a 31% premium. So it's a sell according to my model. Let's see what Simply Wall Street values the company at. They value them at $372. Much different than what I'm valuing them at. So in their model, they may be using things such as the future expectation of the cannabis industry may be growing a lot, and this company may be at the forefront of that. So you have to make your own decision. How do you see the future of the company? I try to limit my model to just based on the previous financial information, because everybody has their own opinion and their own spin on things. If I really felt the future of the cannabis industry was going to be strong and this company was going to be the leader, maybe I would buy the stock, even though my model says not to buy it. I don't just rely on the model. The model is just one reference point I have. So it looks like the stock was trading a lot lower a few years ago. It's come up to 120, it looks like, and then it's come back down a little bit, but it really hasn't struggled too much via coronavirus. It sits around $93. So depending on your outlook on things, a big concern of mine is the cannabis industry. Although it's very profitable, it runs into a lot of problems, political problems and people's emotional problems towards that type of industry, and it just concerns me a little bit when investing. Let's look at the financial ratios. They have a really high PE, so that's not good. That's price to stock over earnings per share. You want a low PE. Their price to sales is also really high. That's price to stock over sales per share. I like to see under 3, they're 44. They have an okay price to book. That's price to stock over book value per share, because they have no debt, so it makes their price to book look pretty good. They have a good current ratio, 2.8. They can cover their current liabilities, no problem. A low ROE of 4%. I like to see above 20% on this. That's income over equity. And they have no debt, so no interest coverage ratio necessary. The best way to look at ratios is to compare them to similar companies. Stag is also an industrial REIT. If the number is in orange, that means their ratio is better than the other company. So they happen to have, ironically, 85.2 PE. You can see it's not exactly the same. IIPR has a little better, but they both have pretty bad PEs. They both have bad price to sales, but Stag is better. Stag has a better price to book. Current ratio, they're both doing okay. They both have really low ROEs. IIPR obviously is doing better in debt because they're 0%. And Stag is a little bigger of a company at $4 billion market cap. So I hope you enjoyed the video. Please leave a comment. Thanks for watching.